Hello. Good evening, colleagues. Good evening and welcome. Welcome to the gala dinner of the 34th EFMA annual meeting. Thank you so much for being here with us. It's a bit cooler now, isn't it? Hope you think this is a good choice. So we are starting with the gala dinner and the ceremony. I'm going to introduce our keynote speaker in a bit. Professor René Stulz is here with us. And then we are going to have the award ceremony. As you know, it's customary with the EFMA. Dr. Doukas will give the EFMA award. After that, we have Dr. Lars Oxelheim, who will do the presentation of next year's EFMA. Okay. And we hope that you will enjoy the gala dinner. So, what can I say? We are honored, privileged to have Dr. Stulz with us tonight, and I'm privileged, of course, to introduce him. René Stulz, the Everett D. Rees Chair of Banking and Monetary Economics and Director of the DICE Center for Research in Financial Economics at the Ohio State University. He's been a faculty member there since 1983, but he has also taught at the Massachusetts Institute of Technology, the University of Chicago, and the University of Rochester. Just a few words about Dr. Stulz. He earned his undergraduate degree at the University of Neuchâtel in Switzerland, and then his PhD in economics at MIT. He has published more than 100 papers in finance and economics journals, including Journal of Political Economy, Quarterly Journal of Economics, Journal of Financial Economics, Journal of Finance, Review of Financial Studies, Harvard Business Review, to mention just a few. His papers have been cited over 120,000 times, and this number is bound to go up because his rate of publication does not seem to be slowing down, on the contrary. Dr. Stulz is also the author of a textbook titled Risk Management and Derivatives, co-author of the Squam Lake Report, Fixing the Financial System, and has edited also several books. But what's even more striking than the number of publications and citations, I think, is the relevance of his work to the real business world, especially his recent work. And as we know, the best test for any model is how well it describes reality. And I think that Dr. Stulz's work has emphasized that in all respects. I was looking at this recent paper on risk, the limits of financial risk management and corporate resilience. That was quite revealing in terms of the total risk, rather than just the financial risk that can negatively impact shareholder value. The financial risk management tools that are perhaps relevant and effective in the short term, but not so in the longer term, which may be even more important. And this sort of investment that firms need to do in terms of resilience as a strategy. So I can think in terms of many, many examples from the corporate world, especially in the post-COVID era, many firms that precisely implemented this type of recipe. The food chains and the restaurant chains, and perhaps also the tech companies like Zoom. A remarkable service to research, but also to the profession in the form of editorial activity. And Dr. Stulz was the editor of the Journal of Finance for 12 years, co-editor of the Journal of Financial Economics for 5 years, and has also served on the editorial board of very many top academic journals, double-digit number for sure. He's a member of the Asset Pricing and Corporate Finance Programs and the director of the Risk of Financial Institutions Group of the National Bureau of economic research. Has taught extensively. Many students of his, I think, in this room too. But also his teaching has had global reach because he taught in executive development programs in the US, Europe, Asia, has consulted major financial institutions such as the New York Stock Exchange, the IMF, the World Bank, has served on bank and asset management company boards as member and vice chair also of the Board of Trustees of the Global Association of Risk Professionals. His academic excellence has earned him international recognition. In 2004, the magazine Treasury and Risk Management named him one of the 100 most influential people in finance, and Reuters includes him in its list of the world's most influential scientific minds. So, ladies and gentlemen, please join me in welcoming Professor René Stulz for the keynote speech of the 34th annual meeting of EFMA. Professor Stulz, the floor is yours, finally.
Great.
I tried not to say too much.
Okay. Sorry. Don't worry. Figure out how to get here. Okay. Great. Good. Well, thank you, Clara, for this introduction. I tried to convince her to keep it really short, and it tells you how much influence I have. But it's a pleasure to be with the EFMA again. I was one of the first keynote speakers of the association, I think in 1994 or 1995. And so, I mean, you should feel good about that, because the fact that they invite me again means that it must not have been that bad. So, I'm going to talk about public markets and whether they have a future. Okay, my starting point is a very well-known paper by Mike Jensen. They published in 1989 called Eclipse of the Public Corporation. Okay, and that paper has quite a number of sites. It's a very well-known paper. And in that paper, Jensen focused on what he thought was the decline of the public corporation. And his argument was that this decline came about because agency costs were poorly managed, in particular when it came to the agency costs of free cash flow. And in contrast, he thought that a new form of organization at the time, LBO organizations, was much better able to handle those agency conflict, and that it was on the rise. So private markets were winning and public markets were losing. The article in the Harvard Business Review had an insert by a colleague of Jensen, Jay Light. And Jay Light had this statement, which is the last share of publicly traded common stock owned by an individual will be sold in the year 2003 if current trends persist. Now, because of the acquisitions and because of repurchases and because of firms going private, the equity was being reduced. We all know that it didn't quite work out that way. At the time that Jensen wrote his paper, there were 6,727 listed firms in the US. With Craig Deutsch, Andrew Cowley, we have a paper titled The US Listing Gap. In that paper, we show that the peak of listings in the US was in 1996 with 8,025 listings. The number of listings fell after that peak, obviously, and it fell below the number of listings at the time of Jensen's article in 2001. In 2023, there are just 4,135 listings. That's 39% below the numbers at the time of Jensen's article, and 48% below the peak. So the question is, was Jensen right, but too early? Or was he just plain wrong? So that's what we'll talk about. I'm going to start by using some new data that Craig, Andrew, and my student Chris Shen put together. And that goes to 2024. Now, in that paper, we have the number of listed firms for the US, for non-US countries, and for non-US developed countries. And you can see that the US has an inverted U shape. The number of listed firms in 1975 is higher than it is today. And the number of listed firms falls continuously from the peak, with one dramatic exception, which was 2021. When you look at the non-US developed countries, which is the red line at the bottom, that number has been kind of inching downwards since the early 2000s, and then accelerated after COVID. So after COVID, kind of the rest of the developed world seemed to go in the opposite direction from the US. There was no burst of IPOs in developed countries. And then when you look at the non-US countries as a whole, it's the orange line. That one keeps going up. And so it means that developed markets have had increases in listing over that, I mean, developing markets had increases in listing. So we have really three different paths of listings. Now, since we are in Greece, you might be interested in what happened in Greece. Greece actually looks very much like the US, perhaps more dramatically. Now, at the start of our data set in '88, it has about 100 listings, goes to 350, and then falls back to 150. So inverted U shape, but steeper than in the US. When you think about the figures that I just showed for the US, it kind of understates the problem. Okay? And the problem is that the population increased. So if you look at listings per capita, the situation is a bit more dramatic. So in 1975, the number of listings per million inhabitants was similar in the US versus other developed countries, about 23. In 2023, the US has 12.9 listed firms per million inhabitants, while the other developed countries have 24.5. Now, so the US is about half of the other developed countries, which is a huge gap. So in my paper with Craig and Andrew, we estimate a model to predict listings across the world. And with that model, the US has fewer listings than predicted. And we call the difference the listing gap. And now we have data that updates this listing gap. And you have it here. Now it developed at the end of the 1990s, and the listing gap increased over time. You can see that with COVID, it fell. But then the most recent estimate that we have is actually the largest ever. Now, and so when you look at this, about 7,000 listings are missing in the US. So if you think that kind of the number that would be similar to other countries when you adjust for financial development on institutions and so on, the US would have about 11,000 listings. So something's missing. So how do you get to have how do you get to have a listing gap? How do you get to have so few listings? Well, the number of listings changes by new lists minus delists. Now, and so the only way that you have the number of listings falling is if you have more delists than you have new lists. And so the black line, the continuous line, is new listings in the US as a rate, as a percentage of existing listings. And the dotted line is the listings. And you can see that before the mid-1990s, the US had periods with very high rates of new lists, essentially lots of IPOs, and a lower rate of delisting. And that switched in the mid-1990s, where the rate of delistings became high and the rate of new lists started to be low. The rate of new lists has been low since then, with the exception of 2021. Okay, and so we have an extended period with more delists than new lists, with a big exception in 2021. But immediately after that, the world got back to what it was before. Now, to be delisted from to delist from an exchange, one of three things can happen. Now, as a company, you get acquired, and that's one less listing if you're a public company. You get kicked out by the exchange because you don't meet the standards of the exchange, or you decide that you have had enough of the exchange and you delist voluntarily. And what you can see here is the red as the mergers, and that's a major contributor to the delist in the US. Decreases for cause are less, but still a substantial number. The voluntary delistings are just not an issue. So with having so few new lists, now one way to say what's going on is that companies in the US are reluctant to list. Okay, and so one way to measure that reluctance is to compute the propensity to list for firms. And to compute that propensity, you take all the existing firms, private and public, and then compute the ratio of the public firms to all firms. Now, it's as an example of that, if you look at firms with more than 1,000 employees in the US, so reasonably large firms, in 1975, about 80% of those firms were listed. In 2023, 50% of those firms are listed. So what I'm talking about is not just for small firms, it affects large firms as well. Now, we saw Jensen's kind of explanation for why there were fewer public firms. It was an agency explanation. For an alternative explanation, early this year, the CEO of Goldman Sachs, David Solomon, now made a widely noted speech where he kind of questioned why startups needed to list. And now think about it. Goldman Sachs made a lot of money from IPOs, and suddenly they start saying, well, you don't really need to list. His argument was that, well, and I'm quoting him, if you are running a company that's working on its growing, if you take it public, it will force you to change the way you run it, and you really should do that with great caution. Okay, and so the view here is not an agency view, but it's a view that if you are public, you are going to have pressures, requirements, regulations, and so on that are going to make your life difficult. And you don't really need to do that because you can get funded in private markets. So with Jensen, we have the agency argument. The private markets are better because of them being being better at controlling agency cost of free cash flow. He didn't say that all firms would leave the markets. He thought that public markets were fine and might have been better for firms that weren't subject to agency costs of free cash flow. Solomon kind of makes an efficiency argument. Now, you can do a better job creating wealth for your shareholders, for your investors, if you stay private, sorry. And so now you have the view that highly successful large startups should not go public. They don't have to go public because the funding is there. And they would have to change too much if they became public. So let's look at these explanations and whether they are helpful to understand what's going on currently. Now, I am not going to spend much time on the agency cost explanation. Now, Mike Jensen died last year, and I just edited an issue of JFE that has papers on his work. On D'Angelo, on Kane, on Kale, on Skinner have a paper on free cash flow on payouts that talks about this quite a bit. But now what has happened is that those agency costs of free cash flow have really decreased in importance. Now, a good bit of that has to do with the institutionalization of investment that took place after Jensen's article. And it has led to a more active role of institutions and the emergence of active institutional investors. Now there is now a lot of work on those investors. One of the main contributors, Alan, is Brav is here. And that has created an institutional pressure that forced firms to pay more attention to capital allocation and to pay out cash that they could not invest profitably. Cassie Kale and I have a paper on payout rates in the 2000s, and we show that they increased, but more importantly, that payouts have become more responsive to new developments at firms. So funding, now as mentioned by Solomon, has increased dramatically in private markets. These are numbers from Bain, and kind of what is useful to notice is that since 2016, from 2016 to 2023, 7 years, every year the amount of funds raised on private market was in excess of $1 trillion. No, so that's real money for everybody except politicians in the US. So now you find a lot of our colleagues and a lot of people to say, well, it's all about funding on what else is there to think about. Now, I think that's just plain wrong in the following way. Now, funding doesn't explain why firms, startups stay private. It gives them the opportunity to stay private. No? And so that's a very big difference. Now, if you're a startup and you are maximizing the value of the startup for your investors, you're not going to stay private if your startup has a lot more value in the public markets. No? So it has to be that you are better off and your investors are better off to stay private, and then the funding is important, because if you couldn't get funded, you still would have to go to the public markets. Okay, and so the big question is, why is it that it might be better for your investors for you to stay private, assuming you're maximizing the wealth of your investors? Now, there's an alternative floating around, which is that it's agency cost of founders. Given that I'm time limited, I'm not going to talk about it. So with Daria Davidova at APFL in Switzerland and Rudi Fallenbrach at APFL, and my former student Leandro Sanz at Notre Dame, we have a recent paper where we look at that, which is titled, "Why Do Highly Successful Startups Shun Public Markets?" And the starting point for our argument and for our explanation of what is going on, remember that the issue is why firms don't go public. And the starting point is what is assuredly one of the most important trends, if not the most important one, for corporations over the last 40 years, which is the increase in the importance of intangible assets. Okay, and that intangible capital has increased enormously. There are really two types of intangible capital. Now, one is knowledge capital, which is what you get through R&D, and the other one is organization capital. Okay, and organization capital is you acquire it by spending on corporate culture, on organization practices, on advertising, on customer capital, on IT, on human capital. Now, that's kind of what it comprises. The importance of those two types of capital differs in a very big way across industries. The plot that I have on the right is from a paper that I like a lot by, I'm going to call it Falato et al. Because I have never succeeded kind of saying the name of the second author correctly, but it's in the Journal of Finance in 2022. Okay, and what you see there is pretty amazing. Now in 1970, intangible assets to net assets was 25%. In 2010, at the end of the sample period, it's 90%. Okay, so it means that intangible capital is 90% of the assets net of cash. Okay, and so that's pretty amazing. So I say that there is a big difference across industries. Here are two examples. On the left, you have the healthcare industry. On the right, you have the business services industry. Okay, and what you see on the left, the dark line is the ratio of knowledge capital to net assets. And you can see for healthcare, that hasn't changed very much over time. And it's a low number compared to the dotted line, which is a ratio of knowledge capital to net assets, and that is quite large for the healthcare industry and has increased over time. Okay, so you have healthcare on the left, you have business services on the right, where you have now the black line is organization capital over net assets, and you see that that has increased over time and is fairly large for that industry, whereas knowledge capital is not that important for that industry. So knowledge and organization capital differ, and that's going to be important as for our explanation of why firms don't go public. Okay, and the knowledge and organization capital have very different properties. When you think of knowledge capital, now the important thing about it is that it can get patented. Now you can get a patent for any invention that you generate through R&D. I mean, I shouldn't say any, but for inventions that you generate through R&D. That makes it possible for you to have property rights to your invention that you can defend. In the US, there's an enormous industry set up to help you do that. And so that's one case. Organization capital is quite different in the sense that you can't really patent it. Other firms can look at what you're doing and mimic it relatively easily. It's very difficult for you to exert property rights to it. Some of it is firm-specific human capital. Now, whereas the ownership of the organization capital is shared between the firm and the employees. And the problem with employees is that they go down the elevator every day at night. And now you want them to come back the next day. And if they don't come back, they have some of the organization capital with them. So organization capital is really fragile for young firms because kind of the individuals that are building that capital are really important to the firm. And if they leave, a lot of it gets lost. It becomes less important for established firms. Okay, there are kind of two great papers on this. One by Holmstrom in '89, and then Raghurajan's presidential address of the AFA in 2012, now which emphasize that as you go public and you become a public firm, now lots of stuff becomes standardized and codified, and you operate differently in that sense. Now, once you have a manual, if an employee leaves, the next one just looks at the manual. Okay, which is very different from a startup where it's in the head of people rather than the manuals. So immature organization capital is difficult to protect. A lot of startups kind of are looking for economies of scale and network effects. and they're using organization capital to get those economies of scale. But if your model is to exploit network effects and economies of scale, the organization capital has very little value unless you achieve that objective of having economies of scale and network effects. Okay, and so kind of the value of organization capital along the way is little because it's worthless if you don't succeed. Okay, and so as a firm, you have to find the institutional environment that is safest for you to build organization capital. Now, and we argue that the return to investment in organization capital for firms with immature organization capital is higher in private market than it is in public markets. And so you want to be private. Why so? Well, in private markets, you have less disclosure. So that makes it harder for competitors to borrow what you're building. There is less poaching of employees because there's just less visibility about what the firm is doing. And then the employees have difficulties leaving because much of their wealth is in the firm and is not really liquid. Now, even if you exercise options while the firm is not public, it's hard to deal with the taxes that you can deal very easy if the stock is liquid. On the public markets, now once you're public, it's much less. It's much harder to kind of focus single-mindedly on scaling. You have public market distraction. You have public market requirements. You also have less stability of employees. That their wealth has become liquid, and the employees get more information about the market's assessment of the firm, and that affects the decision as well. So now what we do is we have a prediction about which type of startups are going to stay private. And now when there's a huge literature on reasons for why startups do not go public, having to do with the disappearance of specialized investment banks, regulation FD, which limits what the firms can tell investors, Sarbanes-Oxley, decimalization. And there's also a very, very nice paper by Gao, Ritter, and Zhou that focuses on economies of scope. Now, in that paper, they show that firms have kind of switched from going public to being acquired through trade sales. And the argument is that for them to kind of exploit what they develop, they have to do it quickly because we live in a global world with much competition, and the best way to do that is to be acquired. What we argue is that none of those reasons can explain why large startups are going to stay private, and we consider large startups to be 300 million headline valuation or higher. Okay, and I don't really have time to explain for each one of those reasons why it doesn't apply to those firms, but let me focus on the economies of scope argument. Now, the main point of Gao, Ritter, and Zhou is the importance of trade sales, but for the startups that have the valuations that we look at, trade sales are less important than IPOs. Now, more than half exit through IPOs, and then SPACs as well. So kind of the argument of the Gao et al. Paper is not very pertinent to what we are looking at. So what we expect with what I said about organization capital is that the large startups are expected to be organization capital intensive and to stay private at least as long as their organization capital is immature. To investigate that, we construct a database from 2010 to 2024 that has all startups that have a headline valuation of $50 million or more. So what do we find? Well, here we have the growth of the number of large startups over a sample period. And you see a pretty steady growth over time with a slight fall in early 2020. The rate of growth has kind of decreased quite a bit, but there is growth essentially throughout our sample period. There is growth in exits, as you can see with the dotted line at the bottom, and there is growth in both, as you can see with the line on top. And you can see that now both lines for exits on both have a strong, a slope in recent years. So there are lots of those. There are more than 1,000 of them alive at the end of our sample period. And so that's an interesting set of startups to look at. Now what we find is that the probability that a startup is a large startup is much higher if small firms in its industry, small public firms, have high organization capital intensity. Now, which is exactly what we would predict, as long as we can look at the public firms and use their organization capital intensity as a proxy for the organization capital intensity of the startups. Now, the problem in the US is that we don't have really data for private firms. The nice thing about Europe is that you have that kind of data. And so I'm hoping that somebody here is going to do what we are doing, but just better. Okay, but that's where we are. What we find is a 1 standard deviation increase in organization capital intensity corresponds to the 24% increase in the probability that a startup is a large startup. We also are able to construct a variable about the business model of the startup on whether that business model involves exploiting economies of scale and network effects. And we find that that also is associated with a much higher probability of a startup being a large startup. So it kind of takes both things. Now it takes organization capital intensity, and it takes the business model involving exploiting economies of scale and network effects. We try to get to at causality. We use the Defend Trade Secrets Act in the US of 2016, and it provides a cause of action for trade secret misappropriation. And so that kind of makes it more worthwhile to invest in organization capital because you can kind of pursue people who outright steal. And the shock impact states differently depending on how they enforce non-compete agreements. And we find that the shock makes it more likely that a startup becomes a large startup. So the results we get are consistent with the prediction that I mentioned. So let's now turn to conclusions. And I have really 3 sets of conclusions. Now, the first one is what explains what the change in IPOs and the change in public versus private markets really has much to do with the fact that firms have changed and are changing. And so Jensen was right that the public firms were going to become less important, but he really was wrong as to the reason. Okay? Improved governance has decreased the importance of agency costs of free cash flow, but the propensity to list has decreased sharply, but because the nature of firms has changed. Now I have a paper with Fred Schlingenman in JFE where we show that now industries where organization capital is relatively less important, that have much tangible capital, are much more represented on the stock market than industries where organization capital is important and tangible capital is not. Now, manufacturing firms are heavily represented on the stock market, but as you know, manufacturing is kind of reducing in importance. Service firms are not well represented, but they are becoming more important. So we make the argument that organization capital has become much more important for firms, and for many firms, the return from investing in organization capital is higher when they are private than when they are public. So does that mean that we have too few firms? Well, that's kind of a complicated question with lots of parts. I've been working on the parts for a while, and I might be doing it for a while longer. But when it comes to organization capital intensity, the fact that we have more of that obviously affects adversely the number of public firms, but it's really not a problem. There is a place that is more efficient for firms to be located at, and that's private market, at least for some of the firms that are organization capital intensive. Mergers is more complicated. There are mergers that are good for the economy, that are good for efficiency, but there are also mergers that just reduce competition and reduce overall efficiency. So depending on how many of the mergers just reduce competition, we may well have too few public firms because those mergers should have been prevented. Then we have regulation. In the US and in some other Western countries, now the laws kind of discriminate against public firms, make it subject public firms to regulations that private firms are not subjected to. Now, in some cases, it may make sense when it comes to investor protection, but there are a lot of restrictions, especially in the US, on public firms that private firms are not subject to, that really don't do anything for investor protection. The last conclusion is kind of going back to a global perspective. That as we saw, the dynamics of listings differ between the US, developed countries, and developing countries. And so that's something that is important to understand. It also offers lots of research opportunities. Now, one possible explanation is that the US is ahead in terms of how firms are changing. And as that happens elsewhere, the same thing happens to the exchanges. Another explanation is that there is a lot of money in the US for private markets. And so as firms change, they are able to get the funding that they need to stay private if that's best for them. Probably both of those factors are at play. And some of those factors may play a role across countries. But knowing the importance of those factors across countries, as well as within the US, I think is something that is worth people spending their time on. Thank you for your attention. I'm happy to answer a few questions if anybody has a question. Or if anybody wants to say that I'm wrong, go right ahead. Why people are... Oh, yeah. Go ahead. Yeah, no, so tax laws play a big role, both for private markets and for public markets. And no, I don't know what the net effect is. You might argue, and I have heard people argue that they favor private markets. I mean, there clearly are features of the tax code that are problematic. But now whether at the end of the day they can explain what's going on, I am kind of doubtful, because you have extremely large public corporations that essentially pay no taxes. And so it can't be that important for those companies. So it's an interesting question. I would love to see work being done on them. Now, at the beginning of the LBO period, or more kind of 10 years in, there were papers arguing that some of it was tax arbitrage. Might be for LBOs, but for the startups that we're talking about, it would surprise me if taxes played a big role. Yeah.
Okay, thank you. That was an amazing keynote. Do you think the extent of the listing gap has something to do with common law versus civil law?
Well, so no, there is literature that I like a lot, and I have some papers in it, now which relates financial development to the origin of the legal system. And in that literature, now people often find that the common law countries are more financially developed than the civil law countries. And there is variation among civil law countries. The kind of Scandinavian law countries are more like common law countries, whereas kind of French origin civil law countries are the ones with the least financial development. I certainly think that laws matter a lot. How much its legal origin as opposed to other factors that affect laws is something worth debating. I think whether investors have recourse to an efficient legal system plays a big role. And I'm hoping that the US will keep having such a system. Yeah?
Many stock exchanges trade their own shares. Do you believe that all listed companies should trade their own shares? And because there's more private companies with share plans that trade their own shares than there are listed companies on the American the New York Stock Exchange.
So I'm not sure I got the question that by trading their own share, you mean they repurchase stock?
No.
No, okay.
They like cooperatives, but it's like private companies with share plans. They organize share trades.
Right.
Employees are coming and going. Stock exchanges have their own shares listed on their own exchange.
Oh, okay, yeah.
Why not all companies do that? Technology would allow it.
Yeah, so, no, I think what's happening with startups in their ability to have kind of auctions for their shares, for their employees, now is an important factor in enabling those startups to stay private and keep their employees happy, because they can exercise options and then sell the shares at these auctions. SpaceX has regular auctions for its employees, but they can't. They are kind of limited in what they can do. I think that's a good system.
So why have public exchanges?
Good question. No? Why do we have exchanges? It enables people to participate in the stock market, and I think it's important to make participation, access to the market as wide as possible. And so the one concern by having private markets growing is that it limits access to investments for people who can't access private markets. But that's something people can do something about.
Exchanges don't disclose who the ultimate beneficial owners are, so you can't get price discovery. You can't get, the purpose of a public market is price discovery, but you can't get it if it's not disclosure.
So you're saying in private markets for those auctions, that's right. No, so I mean, one benefit, obvious benefit of public markets, besides kind of the general welfare issue of distributing risk on making risk-bearing more efficient, is the price discovery on the feedbacks that people get from the stock price, which it's very, I mean, lots of empirical research showing that that's valuable.
They don't get it. The stock exchange rules say you're not allowed to know who the beneficial owners are. And that allows the brokers to trade ahead, short sell, so you don't get price discovery on public markets.
Well, I mean, I agree that there is an issue. I mean, especially in the U.S. I agree with that. Any? Yes.
Thank you very much for the very insightful talk. We understand why private firms may not want to go public. It might be not wise for them to go public. However, do you have some evidence on whether the public firm, when they go collapse, or when the private firms, when they go collapse, the loss will be larger? The reason I ask this is because we can see for private firms, they probably, because they are not subject to that kind of scrutiny regulations. So when they go bankrupt, they can get default 13 times without being charged. They can change the form, change the shell, then they can still get the money for themselves. So, first question, which one may produce more losses to the society and economy at large? Second, from your point of view, do you think we should encourage more public firms or more private firms to develop, to get the net benefits for the society at large? Thank you.
Well, so no, I think it's dangerous to have a world where now people can't access investments in one large sector of the economy, which is the situation in the US for most retail investors. No, that's not good for kind of the support for the market economy over the long run, and can lead to all sorts of concerns. So I definitely think that that's kind of a big issue. I don't think the solution is to try to force firms to be public. Now, that's a regime that we had for a number of years, but haven't had for in the recent past. To the extent that there is greater efficiency in being private for some types of firms, we should allow that. But I think it's important to kind of remove artificial barriers between private and public markets that don't achieve anything. I think it's important to remove kind of the regulations on public firms that really don't protect investors, but make it harder to be a public firm. So I think that's the direction we should be going. Yes, back there.
The US is now moving towards blockchain adoption. And many companies raise it through blockchain. They call it ICO rather than IPO for initial coin offering. Might that be a new kid in town or a new way of financing?
So now in 2018, one of my co-authors and I thought that we were going to write a paper on ICOs. And we looked at it, and by the time we got organized, they kind of decreased in importance rather dramatically. So we gave up. I have very little faith that kind of the financial system is going to change as a result of ICOs and so on. But now that may be just because I don't understand well enough. So I should be cautious. Okay, great. Thank you.